So hi guys, finally RBI has concluded with its fifth bi-monthly annual monetary policy meet. So here are a few key takeaways about the RBI monetary policy meet. Number one, in line with our expectations, the rates have remained unchanged, and at the same time even the stance remains constant at calibrated tightening. Now here are a few important takeaways that we noticed in the policy meet. Number one, along with the rates being unchanged, the outlook or the forecast for inflation has actually dropped to 2.7 to 3.2% as a range for the second half of FY19. Now this comes on the back of severe deflation in food grains, and what is more surprising is that the MSP effect that we all have been waiting for doesn't seem to have played out much all this while. The next important thing is RBI has decided to reduce its statutory liquidity ratio for the banks by 25 bips starting January 2019 and expects to continue it for a few more quarters, at least till it matches up the NDTL of the banks. So let's understand what could have been the thought behind RBI's this decision to cut the SLR. So now is a time when GDP growth forecast remains constant at 7.2%, and at the same time the forecast for inflation has actually dropped to a much lower range of 2.7% to 3.2%. Now within such dynamics, the SLR remains to be a key tool in the hands of RBI to facilitate higher credit offtake and expansion of liquidity within the system. So a cut in the SLR basically leaves the banks with a lot more to lend and at the same time expand credit and consequently increase growth and demand within the economy. So this move seems to be a classic move by RBI to actually facilitate a more robust economy wherein growth and demand spurts from its previous levels. Right now we do not see any rate cut on the way, and at the same time we would actually watch out for how this SLR cut spans out and reflects in the larger macroeconomic data of India. RBI has finally decided to start cutting the SLR or the statutory liquidity ratio by 25 bips every calendar quarter starting January 2019. So what is SLR basically, or what is a statutory liquidity ratio? Let me break it down for you in a very simple fashion. So banks collect deposits from all depositors and is liable to pay it back to the depositors as and when demanded. Now, to ensure that there is never a run on the bank, RBI mandates that every bank parks a certain percentage of its total deposits with the RBI, in exchange of which they receive RBI bonds. So currently the SLR was 19.5% and the target is to reach 18% over the next 6 quarters by cutting 25 bips each calendar quarter.